Today, we're tackling a really heavy but super important topic. What actually happens to the economy, to the markets, when war breaks out? And look, we're not ignoring the huge human cost here. That's a given. But for this explainer, we're going to focus purely on the data. What do the numbers going back centuries really say about how conflict impacts our world?
So, let's get right into it. You've probably heard this idea before, right? It's pretty cynical, but it's out there. The notion that war, despite how awful it is actually good for business? Yeah, it's a concept that's been around forever. But is there any truth to it? Let's actually unpack that argument.
Well, the logic behind it is actually pretty simple. It all comes down to one thing: a massive, sudden flood of government spending. I mean, think about it. When a country goes to war, it has to pay for this gigantic industrial effort, right? And all that cash has to go somewhere.
So how does this work? Well, a few things happen. First, you get a ton of new soldiers, which means more government jobs, more people with paychecks. Then, you've got the government just pouring money into weapons, gear, you name it, and that totally ignites the manufacturing sector. Suddenly, factories that were kind of quiet are running around the clock. And then, and this is a big one, you get this wild side effect called learning by necessity. The pressure is so intense, it forces these huge technological jumps. The classic example? The research for the atom bomb ended up giving us civilian nuclear power.
Then listen, this isn't just some abstract theory. The textbook case for this is the U.S. during World War II. The country was coming out of the Great Depression, and then, bam, the economy grows by an incredible 72% in just 5 years. That wartime production didn't just help win the war, it completely obliterated the Depression and made America the economic superpower we know today. So, that's it, right? Case closed. War is great for the economy. Well, it's not quite that simple.
See, that whole World War II example, it's a huge deal, but it's also a huge outlier. It's really misleading if you think that's how it always works. Because when you zoom out and look at things from a more global view, the picture gets a whole lot darker.
I mean, just take a look at Ukraine. In the very first year of the invasion, its economy just collapsed. We're talking it shrank by about a third. Unemployment shot through the roof, a huge chunk of the population fell into poverty, and a country that was literally known as the breadbasket of Europe suddenly couldn't feed its own people. That is the reality of war for most countries.
So what made the U.S. experience so different? Well, it's pretty clear when you break it down. America is just an anomaly. The big one is that no major war has been fought on U.S. soil since, the Civil War? The factories were already there, and the country was geographically isolated thousands of miles from the actual fighting. For almost everyone else, war means your homes, your factories, your roads get blown up. It means your people are directly in the line of fire. The U.S. basically got all the economic upside of the war spending without any of the devastating costs of having the war fought in its own backyard. And, when you dig into the data from hundreds of wars over the past 200 years, one single thing stands out above everything else as the most important factor. It's not who won or lost. It's not how long it lasted. It's just one simple question. Where was the war fought? And wow, the numbers do not lie. There was this huge study looking at more than 700 wars, and it found that countries where the fighting happened on their own land saw their per capita GDP drop by an average of 9%. Now, just to give you some context for that number, during the absolute worst part of the 2008 financial crisis, U.S. GDP fell by about 4.3%. So we're talking about an impact that is, on average, more than twice as bad as one of the worst recessions ever. But for countries fighting abroad, the impact was basically zero or even positive. It's pretty clear, the bill for war is almost always paid by the battlefield itself. And it's not just about that one GDP number. The ripple effects are just awful. Your labor force gets hammered by casualties and people fleeing as refugees. Your capital, your factories, your farms, your roads, it's either abandoned or just plain destroyed. Trade just grinds to a halt. Nobody wants to invest their money in a war zone, so capital flight is massive. And to even try to pay for all this, governments rack up insane amounts of debt. We're talking, on average, 47% of GDP higher than it was before the war started. Oh, and on top of all that, you get crazy inflation. It is, quite literally, a recipe for total economic disaster.
Okay, so that's the real-world economy, right? The world of actual jobs and factories and stuff. But what about the stock market? Because, let's be honest, the market sometimes feels like it's playing by a completely different set of rules, operating in its own little world.
And what's really wild is how the U.S. market handles these things. The data shows that, yeah, it has that initial panic, that gut punch, knee-jerk reaction when something bad happens, but then it bounces back with incredible speed. In fact, on average, it takes the S&P 500 just 41 days to get back to where it was before the shock. 41 days. So why?
A big part of it is the US dollar being the world's go-to currency, and just how huge and deep the US markets are. When a crisis hits anywhere in the world, money comes flooding into the US looking for safety. It's this weird feedback loop where a global crisis can actually end up boosting demand for US stocks and bonds.
But, and you knew there was a but coming, and it is a huge one. That quick recovery only happens because the US isn't the one getting destroyed. For investors who are actually in the countries where the war is happening, it's a completely different story. I mean, look at Japan and Germany after World War II. Their stock markets were basically zeroed out, gone. There was no 41-day recovery for them. It was game over.
So, okay, this brings up a really practical question for any investor, right? When the stuff hits the fan and markets are tanking, where do you put your money? Is there anywhere to hide? What are these safe havens everyone talks about?
All right, so where does everyone usually run? Well, the old playbook says you do a few things. You buy U.S. government bonds, treasuries, pretty much the safest asset you can own. You move your money into what they call defensive stocks. Think utilities, healthcare, things people need no matter what. And, of course, there's always gold, the original panic asset.
Here's the catch, though. In a real, genuine, market-wide panic, something weird happens. It's called high correlation. Imagine all your different investments are separate boats. In calm seas, they all do their own thing. But in a hurricane, one giant wave just lifts all the boats up or smashes them all down at the same time. That's what happens in a panic. All these assets that are supposed to be different suddenly move together. And that diversification you were counting on, poof, it's gone right when you need it the most.
And we have a perfect recent example, the March 2020 crash. You'd think those safe defensive stocks would have held up, right? Nope. They fell almost as much as the rest of the market. It just goes to show you, when people are truly panicking, they're not thinking about fundamentals. They're just hitting the sell button on everything.
So what about gold? Yeah, gold almost always gets that initial jump when a crisis kicks off. But here's the thing. The research shows that price boost doesn't usually last. Once that first wave of fear passes, the price tends to drift back down. So it might be a temporary umbrella, but it's not the permanent storm shelter people think it is. Okay, so let's recap where we are. It's a pretty grim picture, right? War is terrible for the real economy, especially if you're in the middle of it. The US market bounces back, but not before a whole lot of short-term panic. And those safe havens we all count on? Well, they're not always so safe. So, what the heck is an investor supposed to do with all that? But when a crisis hits, the world pretty much turns into that old story of Chicken Little. Everyone's running around screaming, "The sky is falling!" And that creates this incredibly dangerous feedback loop. Fear makes more people sell, which makes prices drop, which creates even more fear. And today, you've got computer algorithms that are programmed to sell automatically, which just throws gasoline on the fire.
But that brings us to one last really important thought here. All of that fear, all of that panic selling, what does it do? It pushes prices way, way down, often way below what things are actually worth. So what if? What if the absolute worst time to be in the market is actually the best time to be investing?
So if we look at all the data we've talked about, a pattern starts to emerge. War is absolutely devastating for an economy that's on the front lines. But for a market like the US that's far from the fighting, the financial panic is often over surprisingly fast. And that leaves us with a really big question to think about. As an investor, what's the real enemy here? Is it the war itself, or is it our own fear and the panic of everyone else around us? Because what the data really seems to suggest is that more often than not, the biggest risk you can take is listening to Chicken Little.